Imagine just for a second, spending months of your life building what looks like the absolute perfect financial system on paper.
Oh yeah, the ultimate dream.
Right, like you've crunched the numbers, you've run the historical data, you've stayed up late tweaking the algorithms, the back tests are completely flawless, it looks like a money printing machine. And then you finally flip the switch, you take it live into the real world, and you watch it completely violently self-destruct on its very first day. The money just evaporates.
It's the ultimate nightmare scenario for any quantitative trader. You know, you spend all this time building a mathematical fortress and a light breeze knocks the entire thing over.
And you're left sitting there staring at the screen wondering, how is this even possible? I mean, the math said this was safe. Well, today we are taking a deep dive into exactly why that happens. We are looking at a stack of source material that explores the severe and frankly completely hidden risks of something called softening Monte Carlo tests for S&P 500 trading strategies.
It's a really fascinating look into the intersection of high-level statistics and honestly very basic human psychology. The sources detail how traders actively undermine their own work, often without even realizing the scale of the damage they're doing.
Because the goal of this deep dive isn't just to talk about, trading algorithms. We want to understand why incredibly smart, educated traders intentionally weaken their own safety models just to artificially hit a specific pass rate.
Right, they're compromising the foundation.
Exactly. And we want to explore how this seemingly tiny compromise, just fudging a number by a few percentage points, triggers a catastrophic chain reaction. Okay, let's unpack this by looking at the core mechanism of the test itself. We're talking about traders lowering the confidence level of their Monte Carlo tests. But before we get to the lowering part, how does the test actually protect the trader in the first place?
So to give this a little context, a Monte Carlo test is essentially a way of simulating thousands of alternate realities. In trading, you take your strategy and you run it through the simulator to see how it would perform if, say, the sequence of trades was randomized or if market conditions were slightly altered.
It's a stress test, basically.
Yeah, exactly. It stress tests the system to ensure your strategy is actually robust and mathematically sound, rather than just being a beneficiary of good luck in your backtest.
And traditionally, you want a really high confidence level here, right? You want to know with a 95% certainty that this strategy works regardless of the noise. But what the source material is highlighting is this incredibly dangerous trend, where traders are looking at that 95% standard, seeing that almost none of their strategies can actually pass it, and deciding to simply lower the bar.
Yeah, they drop that strict 95% confidence down to, say, 80%, which sounds completely innocuous if you don't understand the underlying mathematics.
Right, because human nature dictates that an 80 on a test is, what, a B minus? You think, well, a B minus is still passing, I'm still safe.
Exactly. That's the trap.
It makes me think of, like a safety inspector at a car manufacturing plant. Imagine the inspector realizes that the crash test for a new car is so rigorous that 99% of the vehicles are failing and getting crushed into cubes. So instead of redesigning the car to make it structurally safer, the inspector just lowers the passing grade for the crash test.
Oh, wow. Yeah.
They just say, you know what? If the crash test dummy only loses one arm and a leg, we'll call it a pass, just to ensure more vehicles make it to the dealership lot and they feel like they're actually being productive.
That is a terrifyingly accurate analogy because the danger is entirely masked until the car is on the highway at 70 miles an hour. What you are doing mathematically when you lower that confidence to 80% is explicitly accepting a 20% probability that your strategy's success in backtesting is nothing more than pure luck.
A 20% chance of just pure luck.
Right. In statistics, this is known as a type I error, a false positive. You are giving the green light to a model that actually has no underlying predictive edge whatsoever.
And the source material gets very specific about why this is so dangerous, particularly for the S&P 500. We're talking about a daily time frame, what they call a D1 time frame, over a 12-month period.
Yeah, if you are trading a daily strategy on the S&P 500 over a 12-month window, you are looking at an exceptionally tiny sample size. You're likely only executing between, say, 20 to 40 trades in that entire year.
Which honestly blew my mind when I read it, because when you hear algorithmic trading, you immediately picture high-frequency bots making thousands of micro trades every single second.
Sure, the Wall Street movie image.
Exactly. But here we're talking about a much slower, methodical strategy, only 20 to 40 decisions a year.
And from a statistical standpoint, a sample size of 20 to 40 is incredibly dangerous territory. With a sample that small, the variability of your equity curve is massive.
Wait, before we go further, what do we mean by the equity curve in this context, just so everyone is visualizing the same thing?
Sure, think of the equity curve as the visual graph of your account balance over time. It charts your peaks of profit and your valleys of loss. When you only have 20 trades shaping that graph, one single lucky trade can make the entire year look like a stroke of genius. It skews the graph upward.
And I guess the reverse is true as well.
Precisely. One unlucky trade can completely tank it. Because of this, the model's actual predictive power, what statisticians call a z-score, is effectively near zero.
Z-score, so that's the statistical measure of whether a result is due to skill and a real pattern, or if it's just random noise.
Exactly that. A low z-score tells you that you simply do not have enough data to prove that your strategy's rules are what actually generated those returns. It could easily just be the noise of the market working in your favor for a brief window.
So when you combine a tiny sample size of 20 trades, where luck plays a massive role, with an artificially softened 80% confidence level, you are basically begging for false positives. You are filling your portfolio with what the math calls false survivors.
You're building a house on statistical sand. You've convinced yourself you have a robust portfolio of proven strategies, but you've actually just collected a bunch of anomalies that happen to survive a weakened crash test.
So if the foundation of the strategy is entirely built on statistical luck, what happens when this false survivor meets the reality of the live, breathing market? Let me play devil's advocate for a second here.
Go for it.
Isn't trading in the stock market inherently risky? I mean, nobody expects a perfectly smooth ride. Surely a slightly softer test just means a slightly bumpier ride, right? You might not make as much profit or you might have a few more losing weeks, but it's not an outright disaster.
That is the exact rationalization that traders use to justify softening the test to themselves. But the source data completely dispels this myth. It is not a bumpier ride. It is a cliff.
A cliff.
A sheer drop. When you take these strategies that passed a softened test into the live market, they have a 40% to 60% probability of hitting drawdowns deeper than any historical limit within their very first 12 months.
Pause for a second. For anyone rusty on the math, a drawdown is basically that peak to trough decline, right? It's the measure of how far your account falls from its highest point before it manages to recover.
Yes, it is the pain threshold of your account. If you start with $100,000, it goes up to $120,000 and then drops to $90,000. That $30,000 drop is your drawdown. The source is stating there is roughly a coin flip chance that your strategy will lose more money faster than it ever did in any of its historical backtesting, and it will do this almost immediately.
Wow, that completely shatters the idea of a bumpier ride. I mean, if you are hitting a historical maximum drawdown in your first few months, your entire risk management framework is broken. You literally don't know where the bottom is.
And it gets worse. The source notes that the overall probability of a total model breach skyrockets to 70% or more.
Walk us through what a model breach actually looks like in real time. If I am the trader sitting at my desk, what am I experiencing?
Okay, let's say you launch the strategy on a Monday. By Wednesday, it takes a loss that is slightly outside the normal parameters. You write it off as a bad day. By week 2, it is executing trades that actively contradict the logic you thought you programmed into it.
Wait, really? It just goes rogue.
Essentially, yeah.
Yeah.
It buys when the indicators say it should sell. The rules you built no longer map onto the reality of the market. A model breach means the strategy wildly deviates from its historical parameters and stops behaving like the model you built. It becomes entirely erratic. You are effectively flying blind at 300 miles an hour.
Here's where it gets really interesting for me. The original analysis brings up a specific term for this. You aren't just letting in strategies that are having a bad week.
The term used in the source text is metki, which translates roughly to junk, or structurally defective models. By relaxing these Monte Carlo filters, traders tell themselves they're just widening the net to find hidden gems that the strict test might have unfairly rejected.
But they aren't finding gems.
No, the math shows they aren't finding hidden gems at all. They are actively flooding their own portfolio with junk.
The text actually states there is a near 100% certainty that these push-through strategies will fail to meet their expected KGR to drawdown ratios, near 100% certainty. And KGR to drawdown compound annual growth rate divided by the drawdown, that is essentially your ultimate measure of risk versus reward, right? How much pain you have to endure for every percentage point of profit.
That's correct. It is the lifeblood metric of a quantitative system. If that ratio fails, the strategy is completely worthless. You are essentially guaranteeing that your system will underperform while taking on a catastrophic level of risk. Because if the process of generating the strategies isn't fundamentally sound and you lower the filters, the only thing that slips through the net is the garbage.
So if we're mathematically guaranteed to hit junk and face a 70% chance of a model breach, what is mechanically snapping inside the algorithm? Do these strategies slowly bleed out over years, taking small paper cuts day by day, or is it sudden?
To understand the mechanism of failure, we have to look at the specific tests that traders are softening. It's not just a general lowering of standards. Traders often soften very specific elements of the Monte Carlo tests, primarily the skip trades test and an OHLC randomization test.
Okay, so if the skip trades test just randomly deletes winning days from the historical backtest, what is it actually exposing about the underlying math? Are we just checking if the strategy got lucky on a random Tuesday?
In a way, yes. It exposes over-optimization, or what statisticians call curve fitting. Because we only have a sample size of 20 to 40 trades, an algorithm can easily just memorize the past rather than learning a repeatable pattern.
So it's not learning, it's just cheating on the test.
Exactly. It might find that buying on the third Tuesday of October historically produced a massive spike. If you run the skip trades test and the simulator randomly removes that one specific October trade, your entire year's profit might vanish. It proves the strategy didn't have a real edge. It just memorized a lottery ticket.
And what about the OHLC randomization test? Open, high, low, close.
All right, so OHLC randomization introduces tiny random variations into the historical price data. It slightly changes the exact price a stock opened or closed at, or how high it spiked during the day. This tests if your strategy is overly obsessed with micromovements, acting like a fragile Swiss watch, or if it actually understands the broader market trend.
This reminds me of a sports analogy. It's like a sports team that spends months memorizing the perfect playbook for playing against one specific opponent. They know exactly where the other guys will stand, but then during the actual game, the other team changes their formation by just 2 yards.
And the team completely freezes.
Yes. If you soften that test, the strategy doesn't just play a little worse. The moment it sees a formation it hasn't perfectly memorized, it completely collapses.
That is a perfect visualization. When a trader softens those specific tests, what they're actually doing is stripping the strategy of its adaptability. They are taking a system that was supposed to be robust and making it incredibly fragile. And what's fascinating here is how this fragility collides with the broader market environment through something called a regime shift.
A regime shift. Okay, how does the source define that?
Markets have different regimes or fundamental moods. Sometimes you are in a low volatility regime where prices move slowly and predictably. Other times you enter a high volatility regime with massive, violent daily swings. You have bull markets and you have bear markets. A fragile strategy one that skipped the strict OHLC and skipped trades tests might look absolutely brilliant during a low volatility regime.
Because it memorized that specific playbook.
Exactly. It's perfectly mathematically tuned to that one specific environment. However, on the S&P 500, a shift in market regime is almost guaranteed to happen within a one-year horizon. The market will inevitably transition from calm to turbulent. When that regime shift hits, the strategy doesn't just experience a dip in profits, it completely collapses. The failure is violent and sudden because the underlying logic of the fragile strategy is completely incompatible with the new market reality.
Okay, this is where I start to lose my mind a little bit. If the math guarantees an astronomical risk of a model breach and market realities guarantee a regime shift that will collapse the fragile model, why on earth are highly educated, incredibly smart traders doing this? Why intentionally sabotage your own work when the mathematical outcome is so bleak?
Because humans, no matter how much math they know, are incredibly susceptible to psychological traps. And the culprit the source material points to is a very famous one, the 80-20 rule, the Pareto principle.
The Pareto principle. Wow, this is literally everywhere in business literature. The idea that 80% of your results come from 20% of your efforts, 80% of a company's sales come from 20% of its clients. Traders have read all the same management books as everyone else, and they've internalized this idea that 20% is this magical, universal constant of success.
Yeah, they look at their Monte Carlo tests, where maybe only 1% or 2% of their strategies are surviving the brutal 95% confidence level. And instead of realizing that finding a true statistical edge in the market is incredibly difficult and rare, they think, well, Pareto says 20% of my strategy should be good. So if only 1% are passing, my test must be broken. It must be too hard.
So they actively artificially soften their tests, specifically because they want to force a 20% pass rate. They want to see that 20% number on their screen to feel like they are making progress, assuming Pareto applies to absolutely every system on Earth.
But if you think about it, that logic completely misrepresents how probability works. This raises an important question. Does the Pareto principle actually apply to the distribution of a strategy's statistical robustness?
Wait, so are you saying everything we learn in business school about the 80-20 rule is just garbage in this context? We just throw it out?
Not garbage, just applied completely backward. The Pareto rule absolutely applies to the distribution of wealth. It applies to the distribution of errors in a software program. But it is entirely misapplied when used as a filter for statistical inputs. The market does not care about your desire to hit a Pareto distribution.
Right. The market doesn't read business books.
Exactly. You cannot mandate that 20% of your strategies are robust winners any more than you can mandate that 20% of your lottery tickets will pay off just because you bought a certain amount of them.
You can't just lower the drawbridge because you feel like more soldiers should be allowed into the castle to hit an arbitrary quota.
The source is exceptionally clear on this point. Your Monte Carlo filters must remain brutally strict, even if it means only 1% of your strategies pass. Even if it means 0.1% pass.
So what does this all mean? If Pareto shouldn't be used to filter the inputs, does it have any place in quantitative trading at all?
It does. Pareto absolutely has its place, but the timing is everything. You don't apply it at the filtering stage, you apply it after the fact, during capital allocation.
Okay. Explain how that changes the dynamic.
Let's say you maintain your brutally strict 95% confidence level.
Hmm.
It takes you months, but you finally find 10 strategies that actually survive the gauntlet. You take those 10 highly robust, deeply adaptable strategies, and you run them in the live market for a year. What you will likely find after that year is that 20% of those strictly vetted strategies, maybe just 2 of them, ended up generating 80% of your total profits.
Wow. So the 80-20 rule still happens.
It still happens, but it emerges naturally from the results.
Yeah.
You don't force the 20% at the testing stage. You observe it at the profit stage. Forcing a 20% pass rate during testing is like a hospital administrator telling a doctor that exactly 20% of the people in the waiting room must be diagnosed as perfectly healthy, regardless of their symptoms, just to meet a daily quota.
That would be insane.
It's dangerous, it's illogical, and it completely invalidates the diagnostic process.
Which brings this whole deep dive full circle. The source material delivers a pretty brutal final verdict on this practice. It states that by softening Monte Carlo tests to chase a psychological quota, a trader strips themselves of the title quantitative alchemist.
A quantitative alchemist is someone who uses rigorous math, strict logic, and unyielding discipline to extract order from the chaos of the market. They rely on the math to protect them from the noise.
But by lowering the standards just to feel the progress of a passing grade, they lose that title entirely. They devolve into a common gambler.
If we connect this to the bigger picture, because a softened model never actually escaped the influence of chance, when that trader takes their fragile 80% confidence strategy live, they are basically rolling the dice.
Yeah.
They're risking hitting the 20% bad universes, the negative statistical probability that they intentionally ignored in their very first month of live trading.
They spent months building a complex, beautiful system just to walk into a casino, close their eyes, and put it all on black.
And the worst part of the psychological trap is that they've convinced themselves they aren't gambling because the system looks complex. The math creates an illusion of safety, even though they intentionally compromise the very equations designed to protect them.
It is wild how human psychology can completely override hard objective mathematics. You now know that in quantitative trading, artificially lowering your standards just to feel the momentum of a 20% pass rate will mathematically guarantee your collapse. The system will self-destruct on day one because you subtly, quietly built it to fail when it encounters the real world. But it makes you wonder if human nature so desperately craves passing grades that we will actively sabotage our own safety nets to get them. Where else in your life or business are you quietly lowering the criteria for success just so you can feel like you're moving forward?